Good morning, everyone. It is great to see you all here. It's my high honor and distinct pleasure to welcome you and serve as the moderator for BrassTax, our session here at 11 o'clock. As John so kindly noted, I am managing principal of Grand Canyon Capital Consultants from Scottsdale, Arizona. It is toasty there, but remember, Scottsdale is the place where summer never ends and winter never comes. I assure you. Okay. That's enough of my Chamber of Commerce support. Grand Canyon, in my experience from 40 years of law practice and doing M&A work throughout that time, and then after retiring from the law practice, staying engaged with M&A advising, business counseling, and capital raise engagements. So Grand Canyon has those three channels of business. So it still deals with people, it deals with money, deals, and thankfully, because of people like our panel here today, it also deals with tax. Don't let the boogeyman get more than the boogeyman deserves, right? But it's such a key critical component that we thought having this topic again featured with such a strong panel of experts, we'd have the audience and the turnout that we have here today. So without further ado, let me introduce our panelists. First, my good friend from our St. Louis days together, we have BRYAN, who's a partner in charge of transaction advisory services and private equity at the Armanino firm. BRYAN has over 25 years of diverse financial and operational C-level experience in public and private companies. His expertise spans various industries, such as multi-channel, healthcare, retail, consumer products, chemical manufacturing, professional manpower services, aerospace, public accounting, and financial services. He has been involved in reorganizations, acquisitions, divestitures, restructurings throughout his entire career, and provides diverse, value-added service to every client. BRYAN, welcome again. Our next panelist is Morgan HOLTMAN, who's a partner at the BakerHostetler firm. Morgan has significant experience with tax aspects of business planning, structuring transactions, and restructuring business enterprises, particularly with respect to pass-through entities. Morgan's practice focuses on transactional tax planning for and tax controversy representation of corporations, partnerships, and other entities in a variety of contexts, including acquisitions, dispositions, and restructurings. She has extensive experience in partnership tax across a variety of industries and in domestic and cross-border contexts, with particular emphasis on complex equity structures, partnership restructurings, and mergers and acquisitions. Drawing on nearly 2 decades of experience in the national office of a Big Four accounting firm and an AmLaw 50 law firm, Morgan knowledgeably counsels clients on domestic and cross-border transaction matters, including with respect to partnerships, limited liability companies, and S-corps, partnership formation, distribution, liquidation, partnership, merger, conversions, and restructuring, and transfers of intangibles, and the impact of tax legislation. You're getting the feeling what a powerful panel this is, aren't you? Despite the moderator. Finally, and certainly not the least, Robert SHEFFERLY III is a tax partner with Plante Moran. He serves in a leadership capacity as a member of the firm's National Tax Office, specializing in assisting private equity funds, portfolio companies, search funds, and owner-operated privately held corporations and partnerships. He specializes in advising clients on complex tax planning and the tax implications of mergers and acquisitions. He has over 20 years of tax experience working within a variety of industries, and his clients appreciate a decisive, results-oriented approach that allows Robert to deliver tax-saving ideas and opportunities. He's known for saving millions of dollars in taxes by utilizing creative tax planning and structuring techniques. Again, thank you, panel, for being here with us to share your knowledge to our great audience. I'd like to first turn to Morgan, if you would discuss a little bit about where things stand on the federal level with legislative matters, and maybe highlight some issues with respect to the profits, carried interest, and BBB partnership audit matters, if you will.
Sure. Okay. Thanks, Dave. And hi, everyone. Thanks for having me. It's a pleasure to be here. So we're going to begin with the tax legislation roller coaster. A year ago, I and probably many of you were bracing for substantial and significant tax reform, if you will. It seemed to me nearly inevitable, given the numbers, the Democrats' control of the Senate, the House, the White House, and how reconciliation works, which requires only 51 votes to pass legislation in the Senate. So, sorry, it's a little, okay. All right, so again, to me, I would have said it's a near certainty that, that we'd have significant tax reform in 2021. But of course, I was wrong, and those efforts fizzled, and we ended the year with really no meaningful tax change. The first half of 2022 has been pretty quiet. There's been a recent uptick in reconciliation activity, recent as in over the last 2 weeks, and I'll describe that in detail in a moment. But the Democrats have nowhere near the momentum going into the fall that they had this time last year. And of course, a lot has changed in the course of the year, including with respect to the economy. So while I certainly can't say with any certainty I was wrong last year for sure, it seems very unlikely to me, and I think to many others, that we will see significant tax reform in 2022. So before I jump into the details of the reconciliation efforts, I just wanted to sort of give you a sense of the general dynamic on the Hill right now. It remains the case that Senators Manchin and Sinema are driving the bus, if you will. Just like last year, every tax proposal we saw last year was the result of an effort to satisfy their demands, if you will, on the tax side. And that continues to be true. In some respects, I think Democrats take comfort in the fact that they don't need to find a large consensus of their members in order to advance a proposal. On the other hand, history has proven that it's really difficult to get the overlapping circle on the Venn diagram that satisfies Sinema, Manchin, and the other 48 senators. So that dynamic is still very much a piece of this overall puzzle. Another thing to keep in mind is that the Democratic majority in the House is only 4 members. And so while early in the process last year, I would have said, pretty likely the House is going to pass tax legislation following the Senate's lead. Senators from New Jersey, New York, and California have made pretty clear that they will not support reconciliation without SALT, cap, relief, or repeal. And I think that's pretty unlikely, relief or repeal, given the economic climate, among other reasons. So, it is not a foregone conclusion that even if the Senate could align on a proposal and pass it in reconciliation, that the House would pass tax legislation as well. And then we have the looming midterm and even 2024 elections. I think there's growing feeling in Washington and elsewhere that the Democrats may well, and likely could, lose control of not just the Senate, but also the House. And given Biden's fairly low approval ratings at the moment, I think Democrats are worried that they may not have the White House in 2024 as well. So this is fostering a sense of urgency, I think, on the part of some Democrats, because the clock is running and, this may be the last chance that they can affect significant tax change for many years to come. Health issues are still a very real piece of this puzzle. Again, for reconciliation, every Democratic senator needs to vote affirmatively, and Vice President Harris would cast the tie-breaking vote. Senator Leahy, Democrat of Vermont, he's 82 and he broke his hip, I think 2 weeks ago. So he's in a rehabilitation facility, for example. It's been reported that Senator Schumer was exposed to COVID over the weekend and he's currently isolating. So, in order to pass legislation, every senator has to be in Washington and vote affirmatively. And there's a real question as to whether that could happen in short order, again, if we can reach agreement with Sinema, Manchin, and the remaining senators. And then there's just sort of the good old political jockeying. Senator McConnell, right around the 4th of July, announced on Twitter that he would not support the bipartisan semiconductor legislation. I always get the name wrong, but it's the U.S. Innovation and Competition Act. So he will not support that effort if the Democrats continue a partisan reconciliation effort. And just within the last 2 days, 2 other Republican senators have signed on to that position as well. So lots of pieces to this puzzle. The stars really have to align in a very special way in order for anything to happen in the Senate and then the House. If we look at reconciliation in particular, so really nothing significant was happening until 2 weeks ago. Schumer and Manchin apparently engaged in some top secret discussions and negotiations, and they apparently have arrived on agreement with respect to a Medicare prescription drug pricing proposal. I don't know the details, but the proposal itself is not tax related. There is a tax component, though. There's a proposal embedded within this larger Medicare proposal to increase the base for the net investment income tax. So that's Section 1411. And this proposal has been tossed around a bit by Biden and other Democrats. The idea currently, under current 1411, as the name implies, the net investment income tax applies to income, pass-through income, and other income that's investment income or passive income. This proposal would extend the base to include active business income, which is 3.8%. So it's not an insignificant change. It could pass through reconciliation. It would mean that taxpayers are subject to a higher tax rate. It applies, importantly, to taxpayers with adjusted gross income in excess of $400,000, consistent with Biden's, commitment to not raise taxes on those making less than $400,000. So it would be important and meaningful, but that's certainly far short of what I would call significant and substantial tax reform. So punchline is it remains to be seen what will happen. Really, no one can predict, but I feel fairly comfortable saying that it's not terribly likely that we will have significant tax legislation in 2022. And so before I pass the baton to Robert, I did want to mention 2 points. Dave mentioned them too. Just technical points that I spend a lot of time thinking about. As Dave indicated, I focus mostly on partnership tax matters and partnership deal work. And so I was trying to think of, the issues that come across my desk every day. And I got a call on profits interest this morning, actually. So profits interests. Profits interests are effectively equity compensation. So, business people like profits interest. It's an interest in a partnership that entitles the holder to share in a portion of a partnership's profits going forward. So post-grant profits and appreciation in the partnership. And business people like profits interest because they incentivize performance. From a tax standpoint, profits interests are very well liked because if they're structured correctly, their grant is tax-free and they give the holder the opportunity to realize capital gain. It is not a sure thing, and I often find myself explaining to clients that it is not the case that you only recognize capital gain with respect to profits interest, but there is the opportunity and maybe even the likelihood that a holder will realize capital gain with respect to a profits interest, and contrast that with other forms of incentive and equity compensation where the holder is going to pretty much always have ordinary income tax at the higher ordinary income rate. So profits interest, very well liked. When you're dealing with profits interest, there's sort of a list of issues that you really want to always keep in mind. And I thought perhaps it's helpful if I just tick through those. The first is really understanding the distribution waterfall in your operating agreement. So, the rights of the profits interest holder are going to be dictated by the cash distribution waterfall. And as I said earlier, it's critical from a tax standpoint that the profits interest holder only share in post-grant economics, post-grant income and appreciation. And that will be true or not based on how the waterfall is structured. So you always do want to pay close attention to the waterfall when you're dealing with profits interest holders. There's a special issue that applies to profits interest holders that also are W-2 wages employees of the issuing partnership. Excuse me. And effectively, this is the result of decades-old IRS guidance that says a person cannot be both an employee, a W-2 wages employee of a partnership, and also a partner in that partnership. So if you observe that a client is going to receive a profits interest and they're also a W-2 wages employee, you really want to think about whether alternative structuring will alleviate this particular issue based again on this historic guidance. There are well-known structures in the marketplace. It's a fairly common issue and common structuring sort of solution, if you will. But again, when you've got a W-2 wages employee, you want to think about whether alternative structuring is important. When I'm talking about profits interest, I absolutely am including carried interest and promote in the real estate context. Profits interest is the big category, but carry and promote are absolutely subsets of profits interest. And so, if you've got a situation where you've got carry, especially, or promote, you really want to always remember 1061. That's the TCJA era carried interest rule, which in general extends the holding period from 1 year to 3 years for returns with respect to the carry to be taxed at preferential long-term capital gain rates. There are tons of nuances in 1061. It's quite complicated. There are a lot of exceptions, a particularly important one for the real estate industry. But if you've got carry, you always really have to be thinking about 1061. And I find that it's not just advising clients and business people at the outset that 1061 exists, but also, as they're moving and their business is growing and they're making business decisions, reminding them that, if in a year they're going to sell an asset or an interest, they really need to just slow down and make sure they understand the 1061 consequences. And then last but not least, there was one more point. Oh, fee waivers. That's sort of an ancillary topic, fee waivers and carry waivers. Those I think are more interesting. They're a little bit more exotic than the other issues I've mentioned. We don't have definitive guidance from the IRS on structuring fee waivers or carry waivers. I see fee waivers quite often. You'll find fee waivers or carry waivers. I see those less often in operating agreements, generally speaking, sometimes a side letter. So if you've got those aspects in a deal where your clients are going to engage in fee waiver or carry waiver, you really want to advise them of the risk, of course, because there is uncertainty. And then I try to just make sure that the waivers are structured, to the extent possible within the existing guidance. So that's just a little bit about profits interest. Do I have 1 more minute or? Okay. Yeah, I see Dave moving. Okay. So the other sort of deal point that often comes across my desk relates to the partnership audit rules. People still refer to them as the new partnership audit rules, but they're not new at all, actually. They were enacted in 2015, effective in 2018, and they really fundamentally changed the way partnerships are audited and how assessments are collected from partnerships. And, I think it's pretty easy, especially from a business perspective, to look at the 1.5 pages or 2 pages of text in an operating agreement about partnership audits and kind of be like, oh, well, that's an audit that might never happen. And if it does, I'll deal with it then. And that is a mistake, I think, because these rules are very complicated. There's a lot of uncertainty because they are so new. But importantly, in many cases, there are very clearly winners and losers in these rules. And I mean winners and losers as between partners. So partners have adverse interests. And it's really important to appreciate that from the outset and to negotiate for your client to put them in the best position in the event an audit happens. So there are 3 situations when I think we really ought to focus on those rules. It's when we're negotiating a JV agreement at the outset, trying to articulate respective rights, and then when a person is selling or buying a partnership interest.
Thank you.
Yeah.
Thank you. Robert,
Yeah,
may I now turn to you?
I was going to make one comment about the W-2 versus guarantee payments. And sometimes I think taxpayers over-exaggerate trying to fix it. Like, if your management teams want to be business owners, well, then they're going to get a guarantee payment. They need to make estimated tax payments. Like, sometimes I don't think it's worth the lift to form another entity, put them in there, have another tax return to file, including all the states that might roll up in there if they can just make estimated tax payments. Like, it's part of being a business owner, and I just say, suck it up and do it.
Yeah, that's right. I mean, I think, it just depends on people's comfort with going from a withholding situation to an estimated payment situation. Yeah. For the most part.
Robert, would you now please share with us some updates on the state local tax matters, specifically the evolution of nexus standards and the new pass-through entity election that is impacting stock versus asset transactions and gross-up analysis?
Yeah, so the world of state tax is continuously evolving, and some of the most recent, well, maybe I'll go back. So back in the 50s, Congress passed PL 86-272, and it was basically a nexus standard that said, here's when states have the ability to tax taxpayers when they come into their states, and what is enough of a presence to allow them. And it generally deals with more manufacturing companies on the sale of tangible personal property. It doesn't protect services. And so that's been around since the 50s. Well, technology has evolved since the 50s, and states have not evolved their tax laws around what we do today. And so I don't know when the Multi-State Tax Commission was created, but it was created a long time ago, where states got together, where they were trying to implement rules that they would all apply together if they joined. Well, not all 50 states joined. I think there might be 15 to 20 states in this Multi-State Tax Commission. And then there's other states that follow some of the rules that they've jointly agreed, but they're not a member. And so the Multi-State Tax Commission came out with some rules recently where they were trying to evolve this 86272 rule to today's standards. And some of those standards had to do with just access to technology, like websites, whether your website had cookies that were being put on your potential clients' computers, of whether those cookies were enough to give you presence in that state to allow that state to start taxing you as a sale to their state. Even if it was previously under 86272, not enough of a presence or nexus to allow that state to tax you. And so they're looking, and there's a bunch of different cookies. I'm not a technology person, but there's a bunch of different types of cookies. Some are allowed, some aren't. Like some that are related to remembering what you put in your shopping cart are okay. But if you have a chat feature on your website, that's automatically going to be enough to say that state can tax you just by having a chat feature. So they're going through a lot of nuances, because clearly states want to find other ways to tax people that they weren't able to tax before. So this is just the evolution. California is not a member of the Multi-State Tax Commission, but they did recently say that they were going to start following this. And they were, I can't remember their exact words, but they basically said they're going to apply this standard as if it existed for a very long time. So they're almost applying it kind of retroactively and prospectively, as opposed to just saying prospectively. So when you translate that to tax due diligence, you're talking to, well, from my perspective, we're talking to a lot of small mom and pop companies that are being bought by private equity. They don't know anything about this. Their small tax advisors don't know anything about this. And they might not have filed anyways, anywhere, but they might have had, a 2 or 3 state exposure, but now it might have ballooned to 10 states if you actually have to apply these rules retroactive. And a concern from a buyer is, depending on whether you're buying assets or buying equity, is going to be continued liability if you're buying equity, or concept called successor liability if you're buying assets, because states do have provisions, not all, but several do, that says if there's a state tax liability, they can follow where the assets went and go after the buyer. And so when you think about certain taxes that would have been applicable, if a company wasn't filing there, the statute of limitations never starts. So in theory, the state could go back 10 years, 20 years and try to, put together records to say this is how much tax you owe them. Versus if a company was filing, well, now the statute of limitations normally would be 3 or 4 years, depending on the state. So the numbers get big really, really fast. We'll see if more states kind of adopt these procedures. I know we've evolved our diligence procedures to ask more questions. Have they considered this? Because we expect more states will adopt, because it's a money grab, right? And it's going beyond what 86272 ever did. So that's probably the most important thing from a diligence perspective. When we kind of transition over and think about the new pass-through entity tax, so this is the evolution of the Tax Act from 2017 that eliminated or minimized the standard deduction for state and local income taxes to $10,000 per taxpayer per year. That had a big, big impact on a lot of states that have high tax rates. California and New York would be, some of the biggest examples. Well, states started putting together kind of workarounds, and it started with one, and a workaround to try to make their tax deductible at the entity level so that it doesn't flow out and be a deduction at the individual level. And so that way you're getting the taxpayers getting, the ultimate owner, investor is getting the benefit of that deduction that they wouldn't have got if it was just treated previously under the old standard. And eventually the IRS came out and actually sanctioned and said, yes, this works, which was really a big surprise. And so once they kind of said that, all the other states started following suit, designing their own programs. And of course, every state created their own program. Nobody could follow the same model. And so the evolution, and from a state's perspective, like it doesn't harm them. Like they're still going to collect the same amount of revenue. It's only going to make more money in the pockets of their residents. And so this was an easy thing. Yes, they got to administer it, but it was a benefit to the residents. So let's do it. Well, in doing it, many states created different rules of how do you adopt or get into this program. So some have elections, some you apply it by just doing it and then you're into the program. Some you have to make estimated tax payments and that's your deemed election. And then some states layered in additional things of you have to elect in or you have to make a payment by a certain date, or if you miss that date, you got to wait till next year. Other states have a provision where if you elect in, you're in for 2 years or 3 years before you can decide to get out again. And so all these states have all these different rules. And so when we start translating them back to kind of M&A transaction, we've got some states recently where we've seen the election needed to be made by filing an estimate by March 15th or June 15th. Well, for whatever reason, this taxpayer didn't elect into this program last year. And now since they missed the date, they can't elect in 22, a year that they're going to have a giant sale with a giant amount of state taxes. So now the question becomes, what can we do to structure around this issue so that they could get the benefit of this deduction? And in certain situations, we haven't concluded yet, but we're trying to read some of the state laws to go, okay, what if we created a new entity? What if we dropped all the assets into a new entity? Could that entity make the election as a new entity, even though the dates passed, but they were started fresh? And so there's a lot of uncertainty in the tax law because it didn't contemplate anything and everything that was possible. Some states say, yes, you got to do it within 3.5 months of the beginning of the year when the entity was formed. Others just say within 3.5 months. So now you got to go, is it an option or is it not an option? So why the pass-through entity election is really important, especially in an exit transaction, is most targets are S corporations. And when you think of an S corporation, they always want to sell you stock because they get to pay capital gains on the sale of their stock at 20%. If they sell you assets, two things, or there's a couple drivers, but there's some ordinary income, which can be taxed as high as 37%. There's additional state taxes if they're in a multi-state and it's higher than their state of residency. So if like a resident of Michigan pay 4.25% on a sale of stock, but that same company sold its assets, if they're filing in New York and in Michigan, well, New York's got a high rate of like almost 9%. So you've got a difference in incremental state taxes by selling assets. Built-in gains tax, we see it occasionally, but it's pretty much gone away because most people have held their stock for more than 5 years after making an S election. So I haven't seen that much. Well, what's happening is you're kind of doing these models to say, what's my after-tax proceeds if I sell stock? What's my after proceeds if I sell assets? And so before the pass-through entity election, it was almost a guarantee it was always going to be cheaper to sell stock. And so we'd quantify that difference and gross it up, and we'd compare that number to the present value of the step up in basis and assets that we're going to get. And so a buyer would then go, okay, I'm going to pay you $1 million, but my present value is $5 million. Okay, I'm going to make that incremental payment. It makes the seller whole from if he would have sold stock, but they got a $5 million benefit on a present value. So net of their million, they're $4 million ahead. Well, now what's changed as more states have adopted the pass-through entity election is that changes the game. So now what we're finding in every calculation I've done except for one, and we've done about 20, is it's actually favorable for the seller to sell assets because under a stock sale, they can't deduct the state taxes, but under an asset sale, they can deduct the state taxes. And so we're actually getting a total flip where it's more beneficial to the seller. And so then when I represent the seller, I'm still going to do the same things I've always done. Purchase price allocation, I want as low as possible to my assets that are going to generate ordinary income, tax at higher rates. But now when I represent buyers, if I know I've got this pass-through entity election, I'm going to be fair with my purchase price allocation to like fixed assets. But if I got like $1 million benefit to the seller, I start increasing my allocation to my fixed assets and I show like $100,000 benefit to my seller. And so I've shifted more purchase price in my fixed assets as a buyer, and I've accelerated more depreciation deductions. And the seller I can't say they don't care. I'm sure they'd like the windfall of $1 million, but I've moved it down to they benefit by 100,000. So that's been a big change, but you've only got the ability to do it is if you're modeling that out and you start seeing the results and you start plugging away at how can I change the price to be advantageous to me as the buyer. And obviously, if you're a seller, continue to negotiate your purchase price allocation, knowing that you probably want a benefit related to the pass-through entity election tax.
And now I'd like to, after we've heard from these great experts at the federal, state, local tax level and impact on M&A transactions, I'd like to turn to old friend BRYAN about, in general, you've been involved in over the last year plus. What have you seen as some challenges, stumbling or roadblocks, and at what point to get a deal to the finish line are the tax experts best to be brought in?
I would say the vast majority of deals that don't go through were really because of the tax issues that came up last minute. And Rob hit on something that I advise our clients all the time to start with is that tax calculation analysis based on, their investment banker's indication of value or our indication of value. Because a lot of times when the owner gets down to the very end and they find out they're not putting as much money in their pocket as they thought they were, that kills the deal. And so being more proactive about that is really important. I can't tell you how many times the tax issues have come up. Rob hit on another one, and I'm actually interested to ask this question to both of you guys on the state issues. How often are you seeing a voluntary filing done prior to the transaction closing to try to clean up issues, whether it's your client or your client's buying them on the other side to have it done because your client is going to follow the rules and file in every appropriate state?
Only on the ones we're doing sell-side tax diligence before they go to market. That's it. Every other one, we're identifying it, and they're going to do a post-close.
We've got a client right now that it's coming down to a week or two before closing, and it started off as we just want to put funds in a tax escrow. And now the buyers come back and said, oh no, we're going to file them for you post-closing. And it's a big enough number that it's probably going to kill another deal. So it's unfortunate. And that, should have been addressed 2 months ago before the LOI was signed.
And sometimes the problem is when you get and identify the nexus issue, the company might be small enough that they don't have the bandwidth to get the right data to calculate an exposure. And so when that happens, now the buyer's exposure, they're going to make as big as they can to have as big as escrow to protect themselves so that they know they can get it done because the company can't get the data or they could never get the data. But now you've got to bring in specialists that can extract data from their software to get the right apportionment information to do the calculations. The easy part is, yes, you have nexus in that state. Next part is, do we get the data to calculate apportionment?
Yeah. So my advice is if you have a client that's contemplating or exploring a sale process, get your tax experts involved on day one to start working through the calculations and just thinking about the tax diligence issues. 8 years ago when I started the transaction practice, sell-side due diligence was really not done very often. And now almost every transaction having a sell-side quality of earnings analysis, the tax diligence, it's the more you can do to prepare for the transaction, the better.
Yeah, I think that's an important comment, not just with respect to the transactions you're mentioning, but just generally. The sooner counsel and accountants can work together, the client will be better served. Just a very simple example, if you're negotiating a JV agreement, there may be provisions, or you may want provisions that dictate how debt basis will be allocated. It's a very specific, piece of my world, the partnership tax rules, but it can be really meaningful. And, a lot of times the tax counsel doesn't have the factual understanding of the deals and sort of the accounting background to figure out how debt would be allocated. But, a quick phone call, and I do this often, to the accountant who knows this more details about the facts of the client, we can figure out pretty quickly, it doesn't have to be a 20-hour exercise. We can figure out pretty quickly what provisions to put in the agreement to put the client in the best spot with respect to even a very small issue. So, and also modeling. I mean, tax counsel really doesn't model, but modeling is tremendously important. I mean, I always say it's nearly impossible to figure out where the chips will fall, at least in a partnership transaction, without a model. So there are lots of reasons why it makes sense for accountants and counsel to work together.
Yeah, I think that partnership is so important. We have a client right now that the structuring was done without our tax partner being involved, and the tax partner had to give the bad news to our client, and the client was not happy. The way it was structured could have prevented a huge tax liability.
And having been in both an accounting firm and a law firm, I've really seen it from the accountant's perspective, and yeah, everyone's just better off if they can work together, the accountants and counsel from the outset.
I'd be specific. The tax advisor and tax counsel working together, not just business counsel, but get the two tax people together. There's huge benefits when we work together. And I love every deal that I've always asked, who are they? Like, I want to get in touch with them right off the bat.
Audience, questions, particularly on this last, I find it very informative discussion. After 40 years of that law thing, the one thing I came away with was I got really good at knowing what I don't know. The list was a lot longer on the don't knows, but as long as we know the right people to bring in and the timing of bringing them in, it does work out well, does it not? Indeed. I had one question just for all of you to talk about. Have you seen, particularly maybe it's been in your fields a lot more common, but I've heard more about SALT, the state and local tax considerations. So, Brian, have you seen perhaps on what could be done on the front end with some of that state local tax consideration in the deal? You said you'd like to see one of your firm's tax partners in from the beginning, but particularly on not just the federal level, but state, local.
Yeah, I think I commented the state issues seem to be the biggest thing that crater a lot of deals because both sides take different approaches. Right now, I've got a client where the buyer says they're going to file, and our client and our tax partner disagrees. But because they're going to file, it's going to create an issue. And so we're trying to work that out. We're trying to understand what does that mean for our client and what types of penalties and interest could come up out of that. And it's a big issue that might kill the deal again.
Robert, on some of the state local tax areas, do you see more states? You said that everyone jumped on board when the IRS had their decision, but are they always relooking at that for the most part? Do you know if some of the states that would be advantageous to know about, to maybe not be in the middle of if something's coming down the pike?
Yeah, I mean, some states made mistakes, and so they had to come back and fix their policy. California and New York both made some mistakes where in California, it didn't work up to their minimum tax, which is only 9%, but anything between 9% and 13%, you were not getting the advantage of the deduction. So they fixed that, but we had a deal close in December, and that was a limitation, so they weren't going to elect in. And so we had to make a gross up payment. But then I think in February, California announced they fixed the law. So now, and it was retroactive. So that fixed. Then New York had a little bit of an issue with their law where all of it was not being subject to the pass-through entity election, only the amount that was apportioned to their state. Well, they realized that they tax 100% of the income to their New York residents and give them credit for taxes paid elsewhere. So they were not getting the benefit of the stuff apportioned outside their state. So they changed that law to say, well, no, we'll withhold on all of the state, all of your income, and give you a credit for the taxes paid. So you get a refund, but you're going to still get all of it as a benefit. So there's been states, those are the two big ones that made mistakes and they fixed it. There's probably others out there I haven't run into yet, but it's an evolving world. A lot of them have sunset provisions that when this law reverts back, I think in 25 to the old rule, like they're all going to go away. So I don't know where this is going to go. I mean, even under the old law, you had AMT issues. So people weren't getting the full benefit anyways. This regime is probably way better for taxpayers if they could stick around, but they got sunset provisions. So whether from 25 or if the Congress changes the law, they've kind of got a provision to kill some of these. So it's an evolving world. We also don't know if the IRS is going to continue with their initial take on that this works. Like, we're still surprised, at least I'm surprised that they allow this.
Morgan, at the federal level, so clearly noted what was thought to potentially be happening and why it didn't and who was more involved, but not the elections and not the politics as much as we always have a lame duck session after an election. Do you see the possibility of even potentially some consensus or a bipartisan effort to address some of these issues that are all over the map, per Robert, from the state level, that Congress could potentially say, all right, we know how to take care of this one last shot?
Yeah, it's procedurally possible. There would have to be a new budget. Reconciliation is a function of a budget resolution. Sorry. So the existing budget resolution expires at the end of September, so there'd have to be a new budget resolution authorizing reconciliation during a lame duck session. I mean, I think the scenario potentially would be if Democrats lose control of the Senate, could they, at the very, very last moment during a lame duck session, pass, reconciliation legislation. And the conventional wisdom, at least from our federal policy colleagues who maintain close contacts with their Hill colleagues, is that that's extremely unlikely. So it's procedurally permissible, but I think a Democrat, once Democrats lose the Senate, if that's what happens, if they then came back in the end of November and December and enacted tax reform, I think the likelihood that they would be elected in the future might be affected in a negative way. So yeah, I think it's possible. I don't think anyone expects that would happen.
And
Hey, Dave, I want to
Yeah,
touch
please,
on
Brian.
something. Rob just briefly mentioned this, and one of the other things I see that comes up with our clients on the sell side that, again, promotes being more proactive in planning is they come to us with an LOI for $50 million and they want to sell their business and it's going to close in 60 days. And then they come back and say, can you do a valuation for $25 million because we want to set up a charitable trust and we want to do some gifting to our kids? And have you guys been involved in that? Because we're trying to advise our clients, you need to be doing that a year before you get into a transaction, not 60 days before.
Yeah, we're seeing it all the time. And some of it's pretty risky stuff that you're like, wait a minute, you're doing this 2 days before you sell and you're making what kind of a discount? There's some surprising stuff on the sell side. And then we just got to go, all right, can we get comfortable as buyers that it's not going to be an issue for us? Yeah. But I think even just going through the modeling and having conversations with your clients, will get more planning opportunities to come to the surface. Even in that S Corp rule for sellers, if you buy S Corp stock, all your expenses, including compensation deductions, are deductible on the return on the date of the transaction, which belongs to the buyer, not the seller, because there's an S Corp rule that says seller's date ends the day before. But if you make this H10 election, well, then it ends on the day of, and the seller gets that deduction. If you're given $1 million bonus, I mean, that could be $350,000, $400,000 of benefit that just walked to the buyers. So these things come out when you have in advance doing modeling projects and helping people plan. And then all those other things come out. Charitable contributions, gifting, what do I want to do?
Join me in a round of applause to thank these wonderful people.